That doesn't mean you have to go to an Ivy League school. That doesn't mean that you have to be the next Tom Hanks, Steven Spielberg, Oprah Winfrey. That just means that you've got to find something that people are willing to pay you to do, preferably legal, that will allow you to sleep under a roof and have food on the table. Anymore these days, brokerage houses are either banks or they're owned by banks. So unfortunately, with the eradication of Glass-Steagall, a lot of people will say, well, what the heck was Glass-Steagall? Well, Glass-Steagall was an act or a law that was enacted shortly after the market crash of 1929 to separate banks and insurance companies from investment firms, to protect people's deposits at banks, because these banks were investing a lot of their money in the market. So people got wiped out. And I'm trying to remember which president it was, and I'm not going to toss out a name because then someone will fact find me and take what's wrong. Came up with the Savings and Loan Association, what was it, FSLIC, that bailed out or created a guarantee for savings and loans or guaranteed your deposits. The Fed did, and they separated banks, insurance companies, and investment firms. And over the years, that there's been a very strong and consistent lobby on Capitol Hill that has slowly but surely eroded Glass-Steagall to the point where, for all intents and purposes, it doesn't exist anymore. All of your major Wall Street firms are either owned by banks or are banks. All of them. Banks tend to utilize what they call the multiplier effect. They are allowed to loan out X number of dollars for every dollar they have on deposit. It's just the way it works. So they figure that they can loan out your money at X amount of interest and make money on it while still paying you X amount of interest on your deposit. Now note I said loan it out here and pay you here, because there is a difference between the two interest rates, what is commonly known as the spread. Let me demonstrate. When you go to deposit your money in a savings or checking account, they're going to pay you X%. When you go to the bank, so you're depositing your money, they're giving you X%. When you go to the bank for money, I'd like to buy a car, I'd like to buy a house, or I'd like to finance my ski boat or vacation, they're going to charge you X%. That difference is what they keep. That's the way banks work. Investment firms, they operate under similar rules and guidelines because, again, a lot of them are either owned by banks or are banks themselves. What they do is oftentimes they will invest your money in what they call money markets. What is a money market? It is a situation where they take your money and they buy short-term investment vehicles, short-term bonds, or short-term loans. Oftentimes they're government or they're high-quality corporate bonds or loans. So the liquidity is typically very high, and the credit quality tends to be exceedingly high, or as high as you can get, which is AAA rated. And because it's not a loan, so to speak, through the bank, they could pay you a little extra on that. And a lot of times investment firms or brokerage houses will do this to entice deposits, to entice people to consolidate their money with the investment firm. So say you've got an individual who's got money at the bank, money at an investment firm, their financial advisor, broker, financial specialist, whatever you want to call them, might say, Mr. or Mrs. Jones, you're getting X% on your money at the bank. If you just bring it over here to the money market, we can give you X+% in our money market at your brokerage account. And Mr. or Mrs. Jones may decide, that sounds like a deal for me. I think I should buy you. And they do. Or they don't. Or they'll leave X amount here just to make sure that they can keep that relationship, which is not uncommon, and move the bulk of their assets over to the investment firm. which investment firms do things with as well. So it's their money's not just sitting there. They're utilizing your cash on deposit as well.
Right.
Because money markets, although they are fairly liquid, they're not cash. They are not cash. Make no bones about it. When you put your money in the bank, it is cash. Meaning you can go down there and demand that money yesterday. You deposited this morning, you get it out this afternoon. When you're dealing with a money market at a brokerage account, as a brokerage firm, they guarantee the liquidity because they're required to. They're required to have certain insurance as well, like a bank does. But they do not guarantee that that money market is going to maintain a dollar for dollar ratio. It can theoretically slip below $1. I will always do my best to answer your questions in a very direct, non-convoluted way. After all, I'm not Alan Greenspan. So if you want to contact me, please feel free to email me at eyeballs.com. I try to tell it like it is or as I see it, and I hope that helps.